Hello everyone. What we're going to work on now is the Chapter 2 presentation. In Chapter 2, we are going to talk about the general framework of the financial statements for a local government, a state or local government. So basically what we're going to see is with financial statements of a government, there are going to be two levels of financial statements we're going to see. First, we are going to have the government-wide financial statements, and then we're also going to have the fund financial statements. The government-wide financial statements are primarily the consolidated financial statements for the entire government operation. And you are going to find that the government as a whole is broken down into different funds. Think of a fund as a separate little subsidiary. So we have all these little subsidiary financial statements, and of course we will consolidate up to the government-wide financial statements. Each of these sets of financial statements are prepared using either accrual accounting or modified accrual accounting, and I will explain that in the slides to come. Okay, first, the government-wide financial statements. The government-wide financial statements will use accrual accounting. So this is the accounting method that most of you have learned in your other prior accounting classes that you've already taken. With accrual accounting, the concept is on the full economic resources. The focus is on the full economic resources of the government, and we are to be accountable for the entire operations. So all three of these terms I need you to link together. Accrual, economic resources, and operational. There are two financial statements that are required at the government-wide level. The first is a balance sheet, and the formal name for the balance sheet is called the Statement of Net Position. There is also an operating statement that is required for the government-wide statements, and that is called a Statement of Activities. In a for-profit world, we would call the statement of activities an income statement. Now for the funds. There are three categories of funds. The first category is called the governmental funds. The governmental funds are to account for the general government operations of the government. So here we're talking about police services, fire services, city hall operations, roadways, things like that. With the governmental funds, we actually have to use the modified accrual basis of accounting. This modified accrual basis of accounting we are going to discuss in depth in the next 4 or 5 chapters. With modified accrual accounting, the accountability is not on the operations, but on the fiscal year. So fiscal accountability, and it's going to be interested in the flow of not all of the economic resources, but the current financial resources. So just like with accrual, we matched up with operational accountability and economic resources. With modified accrual, we need to match it up with fiscal accountability and current financial resources. The second category of funds is called the proprietary funds. Proprietary funds are to account for the business type activities of a government. A business type activity is primarily when a user pays a full user fee to cover all of the expenses of that particular operation. Examples of business type activities would be maybe a bus service, a subway service, water utility plant, maybe a golf course, a toll road. Those would be all examples of users actually paying an additional user fee that's supposed to cover pretty much the entire expense of that operation. And then lastly, we have fiduciary funds. Oh, let me go back. Proprietary funds use accrual accounting. And the last category, fiduciary funds. Fiduciary funds are where the government is responsible for managing other people's assets. but they don't own them. So an example of a fiduciary fund would be like a pension fund, where government employees and retirees actually own all of the assets of the pension fund, but the government is responsible for managing that pension fund for the employees and retirees. Fiduciary funds use accrual accounting as well. Now, before I flip the slide, I want to point out that the governmental funds and the proprietary funds will consolidate up into the government-wide financial statements. The fiduciary funds, even though we separately state the financial statements, they do not consolidate up to the government-wide statements. And I think that would make sense because these are assets that don't belong to the government. The government just has a fiduciary responsibility to manage those assets for somebody else. There are two governmental funds, a balance sheet and an operating statement. That operating statement is called a statement of revenues, expenditures, and changes in fund balance. I need you to take a look at the name of that operating statement because there are a couple of new vocabulary words that you need to be familiar with. The first is expenditures. Because modified accrual accounting is used, we don't actually use the word expenses. We actually use the word expenditures. And the equity is going to be called fund balance at the governmental fund or modified accrual level. The next category of funds, the proprietary funds, there are three required financial statements. We have a statement of net position, which is a balance sheet. We have the operating statement, and that is called the statement of revenues, expenses, and changes in net position. And lastly, we have a cash flow statement. So from these statement names, you can clearly see that equity is called net position at the proprietary fund level versus fund balance for governmental funds. And a cash flow statement. And just as a side note, the direct method of cash flow statement is required. And we will discuss that in more depth as we get to the proprietary fund chapters. And last category, last but certainly not least, the fiduciary funds. There are two required statements, just like the governmental funds, effectively the balance sheet and the operating statement. Okay, now we're going to see that there are also required reconciliations that need to be reported. There are two required reconciliations. And let me explain. Because governmental funds use modified accrual and government-wide statements use accrual, we actually need to show a reconciliation to go from the equity of the modified accrual governmental funds all the way down to the equity of the accrual-based government-wide statements. We also need to show the change in equity on the modified accrual governmental funds all the way down to the change in equity in the accrual-based government-wide statements. These are required reconciliations so we can see the differences between modified accrual and accrual. Okay. Three categories of funds. The first category, the governmental funds. This is where we're going to record the general government activities of a government. Here are the 5 types of governmental funds. The first one is the general fund. I like to call the general fund the default fund. Basically, all the general government activities will flow through the general fund unless they have a reason to flow through one of the other 4 governmental funds. Those other 4 governmental funds are as follows. First, the special revenue funds. A special revenue fund is used when a revenue source is either restricted or committed. A restricted revenue source is when a third party or a law is dictating how we can spend those monies. Let me give you an example. Let's say the federal government gave a local municipality a $2 million operating grant to open up an aftercare program for school children in the community. Because these grant monies can only be spent on that purpose only, and the federal government being a third party, that would be considered a restricted resource. And then the second one that I said there was a committed resource. A committed resource is when the local government's elected officials, that would be the mayor and the other commissioners, when they vote on how to spend a certain sum of money, that would be committed. So if we have restricted or committed revenues, we can actually account for it in a special revenue fund. Now let's skip debt service fund for a second. Let's move over to the fourth column here, the capital projects funds. The capital projects fund is basically when the government is actually constructing a long-term general construction project. So they're building a new city hall or a new fire station or a new park. All right, so all the activity of the construction would flow through the capital projects fund. And now let's go back to the debt service fund. The debt service fund is to pay back the long-term principal and interest of general government debt. You will find as we study that the capital projects fund and the debt service fund are very closely related. Usually what happens is in order to get funds to build the project, the government goes out and gets bond money or a loan from the bank. They build the project, they have a lot of fun doing so, and then there's a bunch of debt left over. And that is when the debt service fund takes over. And then last but not least, we have permanent funds. A permanent fund is basically when the government receives a permanent donation from a donor. And what I mean permanent donation is basically the donor never wants that principal spent. It must remain permanent. And the whole idea is that donation should be invested and the investment earnings be used for a certain project within the government, but the original donation to be kept intact. The second category of funds, the proprietary funds, are to account for the business type activities of the government. First, let's look at the one on the right side, the enterprise funds. The enterprise funds is when the government provides a service to the residents and the visitors in the community for a user fee. Example, the subway, the bus, the toll road, the water utility plant, the golf course are some examples of enterprise activities. And then on the left side, we have the internal service funds. Think of the word internal. This is basically when one government department services other government departments. So as an example, the IT department. The reason that they exist is so they can serve other departments, all the other departments. Another example would be the central garage. Right? We have a central garage where the city hires a whole bunch of mechanics. And basically what's going in, we have police patrol vehicles, we have fire vehicles, we have the parks and recreation vehicles, we might have the mayor's city vehicle, whatever. All vehicles are going to be serviced through this mechanic shop. That would be an example of an internal service fund where one government department is serving other government departments. Okay, now between the governmental funds and the proprietary funds, these two categories of funds will consolidate up to the government-wide statements. The government-wide statements have two columns. There's a governmental activities column and there's a business type activities column. You can see all the governmental funds on this slide will consolidate up to the governmental activities column. Restated at accrual accounting, of course. Remember, at the fund level, it's modified accrual. These proprietary funds, the internal service fund could go either way, but most likely they go also into the governmental activities column in the government-wide statements, but the enterprise funds are going to flow up into the second column on the government-wide statements, and that would be the business type activities column. And our last category, fiduciary funds. The fiduciary funds, first of all, use accrual accounting. Second of all, they're reported on a standalone basis, but they are not, and let me repeat, they are not reported or consolidated up to the government-wide statements. There are two types of fiduciary funds. We have custodial funds, sometimes or in the past called agency funds, and then we have trust funds. Custodial funds are more of a quick pass-through. A good example of a custodial fund would be a county tax collector. For those of you that own a property or you know what a property tax bill looks like, you know that the property owner pays multiple governmental agencies taxes. They don't just pay one government. If I look at my personal property tax bill, I'm paying the local city I live in, my county, my school district, fire district. I probably pay 9 or 10 or 11 different government agencies. I only write one check made payable to my county tax collector. The county tax collector then takes that money and flows it through a custodial fund. Then that custodial fund disperses my funds into the 9 or 10 or 11 different places it needs to go. So you can see that that county tax collector doesn't own the check that I wrote, but they are basically a quick pass-through. All right, versus a trust fund. A trust fund is more of a long-term situation. All right, we've got the government managing pension monies or investment monies or maybe even private purpose monies, where the pension would be where the employees and retirees, they've basically given the government the responsibility to manage those funds for them. Or maybe a bunch of governments get together and they pool all their investments. All right, there would be at least one of those governments would not need to stand up and say, we will take charge and report on the investment trust fund. And then also we have private purpose trust funds where the government might get together with a private entity. All right, and if it's not a government purpose, all right, it would be accounted for through a long-term trust fund. So fiduciary funds, once again, reported on a standalone basis, but not reported through up to the government-wide statements. As we mentioned a few moments ago, the equity of governmental funds is called fund balance. There are 5 categories of fund balance. I've already talked about 2 of them, restricted and committed. In summary, to refresh yourself, restricted resources come from third parties or a law is dictating how we can spend those monies. Committed is when the elected officials vote on how to spend certain monies. Now let me explain the other 3. First up top, non-spendable fund balance. This is when we have an asset that's not in liquid form, like we have a receivable or inventory on our balance sheet for a governmental fund. We should have a corresponding amount in a non-spendable fund balance account. It is physically not spendable yet. We don't have the cash yet. Okay, next, assigned. Assigned is basically when the elected officials delegate to a responsible management member how to spend certain funds. Let me give you an example. Let's say that the mayor and the other elected officials vote to give they set aside $3 million and they give the finance director or the budget director or the police chief or the fire chief the authority to decide how to spend those monies. They've basically delegated or assigned those funds. And then last but not least, unassigned. That is basically the leftover, which basically means anything could be done with those funds. And the last concept of Chapter 2 is this concept of major fund reporting. Basically, when you are preparing governmental funds and enterprise funds in the financial statements, if a fund is considered a major fund, they're going to get their own column on the financial statements. Any fund that does not meet the mathematical calculation to be a major fund are going to be they're all going to be combined into a column that's called non-major funds. Okay, so there is a mathematical formula. Basically what a major fund is, once again, basically what it means is a major fund, they're reported in their own column on the fund financial statements. The general fund is always a major fund. And then the other major funds, there's a math test. You basically got to take the fund's assets, liabilities, revenues, and expenditures. All right. See if they are at least 10% of the category and 5% of the grand total. All right. Let me give you an example. We have governmental funds and we have enterprise funds. By the way, major fund reporting is only for governmental funds and enterprise funds. So what we're going to do is we're going to take, let's take it as an example, special revenue fund. As we said earlier, a special revenue fund is a governmental fund. So what we're going to do is we're going to take the special revenue fund's total assets. We're going to compare the special revenue fund's total assets to the total of all of the governmental funds' total assets. If the special revenue fund's total assets are greater than 10% of all of the governmental funds' total assets, we could put a check mark there. And here's the second test. The special revenue fund's total assets needs to be greater than 5% of the grand total assets of governmental and enterprise funds combined. So there's basically a 10% test and a 5% test. You can do those tests for assets, liabilities, revenues, and expenditures/expenses. If a fund meets the 10% and the 5% test in any of those four categories, it is a major fund. It could meet it in 1, 2, 3, or 4. It doesn't have to meet the test in all four. Just one. It could beat the asset test, the liability test, the revenue test, or the expenditure/expense test. All right, there is a homework problem to determine major funds, and certainly that will be discussed as we answer and go through our homework.